Minority mindset just showed the scariest chart in the market. The crash did not happen when the oil crisis started. It happened after people thought the crisis was over. That is the trap. In 1973, war exploded in the Middle East. Oil prices surged. Inflation started spreading. But the stock market did not immediately tell the full truth. People waited. People hoped. People thought the system was handling it. Then the embargo ended. The headlines calmed down, and investors started to believe the worst had passed. Then the delayed damage hit. Stocks collapsed. Inflation stayed. Salaries could not keep up. And the middle class learned one of the most brutal lessons in economic history. The market can look calm, while the real economy is already poisoned. That is why 2026 feels so dangerous. Energy shock, sticky inflation, Kevin Warsh taking over the Fed, rate cuts getting pushed back, a $39 trillion debt wall, and a new crypto dollar narrative trying to convince people that the next monetary reset is an opportunity. Maybe it is, but maybe it is also a trap, because inflation does not hit all at once. Oil moves first, then diesel, then shipping, then fertilizer, then food, then car production, then insurance, then rent, then your paycheck realizes it is too late. That is the 6 to 18 months lag, and right now, the market is acting like the danger is contained. But the pavement says something else. The gas pump says something else. The grocery receipt says something else. The household budget says something else. Welcome back to Broken Economy. Today, we are breaking down minority mindset's warning about the oil shock lag, the 1973 crash pattern, the Fed's impossible choice, and the crypto dollar narrative, not as a history lesson, not as market drama, but as a survival warning for ordinary workers, because the most dangerous moment is not always the explosion. Sometimes the most dangerous moment is the silence after the explosion. That is when people lower their guard. That is when investors think the risk is gone. That is when households stop preparing. That is when Wall Street starts selling the recovery story. And that is often when the delayed bill begins moving through the economy. Let's start with 1973. The oil shock did not just make gasoline expensive. It moved through the entire system: transportation, manufacturing, food, automobile, housing, Vargas, corporate margins, government policy. The oil embargo strained a U.S. economy that had become deeply dependent on imported oil, and even after the embargo ended, oil prices remained elevated, and the damage continued to move through the economy. That is the part most people forget. The headline can end before the cost does. A war can pause before the supply chain heals. Oil can come down before groceries come down. The market can rally before households recover. And that gap between headline relief and real-world relief is where ordinary people get trapped. In the 1974 cycle, the stock market eventually fell more than 40%. But the psychological damage was even bigger. People learned that inflation does not need to arrive all at once to destroy a salary. It can grind you down slowly, one bill at a time, one price increase at a time, one delayed pass-through at a time. That is what Jasplit is warning about. The market may look calm, but the lag is the real danger. Now compare it to 2026. We already had the money printing foundation from the pandemic years. We already had asset inflation. We already had a housing affordability crisis. We already had high debt. Then the Middle East shock hits. Oil jumps. Energy costs rise. Shipping becomes more expensive. Diesel becomes more expensive. Fertilizer becomes more expensive. Food production gets pressured. Manufacturing costs rise. Then the official story says, "Do not worry. Markets are fine. Stocks are barely down. The crisis is contained." But that is exactly how the trap works. The stock market is not the grocery store. The S&P 500 is not your fuel bill. A headline rally does not refill your fridge. A green market day does not lower your rent. And a temporary oil pullback does not erase the costs already moving through the system. This is why the 6 to 18-month lag matters. Energy is an input. It touches everything. The truck that brings food to the store, the fertilizer used on crops, the plastic packaging, the factory, the warehouse, the airplane, the delivery van, the insurance model, the repair bill, the car part, the restaurant menu. The lag means the full pain arrives after the public stops paying attention. That is why this moment is so dangerous. People are watching the stock market, but they should be watching the receipts. Now let's talk about salaries. This is the quiet destruction. During inflationary decades, wages can rise, and workers can still get poorer. That sounds impossible until you look at purchasing power. If your salary rises 7%, but your cost of life rises 12%, you did not get a raise. You got a smaller loss. If your wages rise over 10 years, but housing, cars, tuition, food, and energy rise faster, your life gets harder, even though your income number looks bigger. That is how the system gaslights workers. It shows nominal income. Workers feel real cost. The paycheck says progress. The grocery bill says decline. The chart says wage growth. The household says no surplus. This is why relying only on salary is dangerous in an inflationary cycle. A salary adjusts slowly. Assets adjust faster. Energy adjusts instantly. Food adjusts quickly. Rent adjusts on renewal. Insurance adjusts brutally. Debt adjusts through rates. But the worker waits for a raise. By the time the raise arrives, the market has already repriced life. That is the legal washout. Nobody steals your paycheck directly. They just make everything around it cost more. Now let's talk about assets. Jaspreet's point is that different assets behave differently at different stages of the cycle. During the short shock, paper assets can get hit hard. Stocks may fall because margins compress, rates rise, and uncertainty explodes. Real estate can appear stable at first, but if inflation is high and rates are high, real estate can still lose in real terms. Gold can perform strongly during panic and distrust. Over longer periods, stocks can recover and compound. Real estate can regain strength. Gold can protect purchasing power, but may not always dominate. The key lesson is not buy one thing forever. The key lesson is stage awareness. A shield in one phase can become dead weight in another. A risky asset in one phase can become the winner later. Cash can feel safe in the short term and dangerous over time. Gold can protect in panic, but underperform in a growth boom. Stocks can crash in the short term and still win over decades. Real estate can lag during high-rate stress and recover when financing improves. This is why ordinary investors get hurt. They buy yesterday's winner. They sell during panic. They hold cash too long. They chase after the move. They confuse a long-term asset with a short-term shield. And they forget that inflation changes the rules. Now bring Kevin Warsh into this. The market wants rate cuts. Trump wants rate cuts. Borrowers want rate cuts. Real estate wants rate cuts. The stock market wants rate cuts. The government wants cheaper debt. But inflation is not dead. If Warsh cuts too early, the dollar can weaken and inflation can come back harder. If he holds rates high, debt pressure continues. If he hikes, markets can break. If he cuts, the inflation lag may become worse. That is the Fed's trap. And ordinary workers sit at the bottom of it. If rates stay high, credit cards stay brutal, mortgages stay painful, auto loans stay expensive, small businesses slow down, hiring freezes. If rates fall too early, asset prices may rise, while groceries and energy keep hurting households. Either way, the middle class pays, through interest, or through prices, through debt, or through dilution, through layoffs, or through inflation. That is the no clean exit economy. Now let's talk about the crypto dollar narrative. This is where the story gets more speculative, so we need to be precise. The US dollar is not officially backed by Bitcoin. That is not the current system. But the political and financial narrative around a strategic Bitcoin reserve, crypto reserves, stablecoins, and tokenized assets is becoming more important. The reason is simple. The old system has a debt problem. The US government owes almost $39 trillion. Traditional buyers of US debt are not unlimited. Interest costs are huge. Deficits are persistent, and the system needs new sources of confidence and demand. That is where crypto enters the story. Bitcoin can be framed as digital gold. Stablecoins can create demand for short-term treasuries. Tokenization can distribute assets to more buyers. Crypto ETFs can bring retirement and brokerage money into digital assets. Strategic Bitcoin reserve proposals can create a new confidence narrative. Again, this is not the same as saying the dollar is officially backed by Bitcoin, but it does mean digital assets are becoming part of the monetary story. And when a debt system needs a new story, ordinary people need to ask, who supplies the liquidity? Because every cycle needs buyers. If crypto becomes the new confidence trade, early holders may benefit, but late retail buyers can become exit liquidity. If stablecoins grow, treasury demand may grow too. If Bitcoin gets wrapped into policy narratives, volatility may become part of the system. If 401ks and ETFs increase exposure, ordinary retirement money becomes more connected to the cycle. That is the risk. The system sells innovation, but underneath, it may also be searching for new buyers for old debt. Now let's bring this back to the street. Imagine a worker with $10,000 saved. They are scared of inflation. They see Bitcoin rising. They hear about gold. They hear about tips. They hear about rate cuts. They hear about the 1973 crash. They hear about the crypto dollar reset. They feel like cash is dying. They feel like they have to do something. That pressure is dangerous, because fear makes people move without a plan. If they stay in cash, inflation eats them slowly. If they buy Bitcoin at the wrong time, volatility can punish them fast. If they buy stocks before a lagged crash, they can get hit. If they buy gold too late, they may sit through years of underperformance. If they buy real estate at high rates, cash flow can disappear. There is no risk-free option. That is the point. In a broken economy, every choice is a risk. Cash risk, market risk, inflation risk, volatility risk, liquidity risk, job risk, policy risk. The goal is not to find the magic asset. The goal is to understand the cycle and survive it. Now what should people watch? Watch oil, watch diesel, watch fertilizer, watch shipping costs, watch food prices, watch insurance, watch the Fed's June decision, watch the 30-year Treasury, watch credit card delinquencies, watch layoffs, watch whether the stock market starts pricing the lag, watch gold, watch tips, watch Bitcoin, watch stablecoin regulation, watch strategic Bitcoin reserve headlines, watch whether retail investors suddenly rush into the same safe trade at the same time, because when everyone panics into the same door, that door gets expensive. The 1973 lesson is not only that stocks can fall, the deeper lesson is that markets can misread the timing. The economy can absorb the shock slowly, then reprice suddenly. The public can think the crisis is over, then the delayed damage can arrive. That is why stocks look fine may be the scariest sentence in the room, not because a crash is guaranteed tomorrow, but because calm can create complacency, and complacency is where risk hides. So here is the broken economy conclusion. Do not let a green stock market convince you the oil shock is over. Do not let a temporary peace headline convince you grocery inflation is done. Do not let a crypto narrative convince you there is a risk-free escape from the debt system. Do not let salary growth convince you your purchasing power is protected. And do not let Wall Street sell you urgency without understanding who benefits from your trade. Minority mindset. Explain the historical pattern. Broken economy is showing the pavement level risk. The oil shock moves first. The inflation lag moves second. The Fed trap moves third. The asset rotation moves fourth. And the worker gets the bill last. Go to the comments and tell us what you think. Do you believe today's market calm is real? Or are we standing inside the 6-month lag? Are you preparing for a delayed inflation hit in groceries, gas, insurance, and rent? Are you holding cash, buying gold, buying tips, buying Bitcoin, buying stocks, or staying on the sidelines? And would you trust a future dollar system that leans on crypto, stablecoins, and tokenized assets to restore confidence? I'm reading every response. The 404x resistance needs the raw truth from the pavement. Subscribe to Broken Economy for more clear breakdowns of finance, technology, markets, labor, and the real economy behind everyday life. Stay awake. The crash does not always arrive when the war starts. Sometimes it arrives after everyone stops looking.